this is an incredibly important change to our law. And bearing in mind, yes, there's a double tax treaty that will also still be there. But in terms of domestic law, and advice to clients who have planned 3 years or 5 years in advance to come to South Africa, and based on their pension being offshore, will not be liable for certain taxes until they trigger tax residency. And even then, their pension's exempt. I've got clients who, how do you talk to those clients? How do you deal with that? It's someone who's set up their life in a way and a manner based on our law that is all of a sudden is going to be deleted, is the correct word to be used.
A very good morning. My name is Delano Abdoll. I am the legal manager of cross-border tax at Tax Consulting South Africa. And today I'm very excited to exchange a few words with my colleague, John-Paul Fraser. He's the team lead of cross-border taxation at Tax Consulting South Africa. And we would like to talk a bit about the big law proposed changes regarding retirement funds. John-Paul, any opening comments on today's topic?
Well, I think firstly, it's been a while since we've done an interview together. So as much as you are excited, I think I'm a bit more. So yes, I think, well, mine's exploding with comments. But first things first is what's important to know about this is retirement funds are almost seen as sacred. Tax-wise, as well as that's what's compulsory for employment to contribute, for example, in most jurisdictions around the world. So the fact that we are removing an exemption on foreign pension funds, which is essentially what we're going to be talking about today and we'll elaborate on, is a big move. Not a surprising one. We've heard wealth tax, we've heard VAT on digital services, we've heard et cetera, et cetera. There's one that no one has heard of yet, but that's probably in the next series. But long story short, South Africa removing this exemption, firstly, as we both know, stems from 2013. So we've got to the point where we don't really have a choice. But yeah, that's my opening comments.
I think there's a lot to kind of delve into. We know as a firm, we don't like to speculate when it comes to tax. The big thing is the proposed changes were published by National Treasury very recently in draft format. And the specific section that we're referring to in the Income Tax Act is section 10(1)G capital C, Roman numeral 2, right? Why do you think the proposal speaks to a complete removal of the exemption? Do you think it's time where we actually at a very desperate stage to collect tax? So SARS and National Treasury are taking a bit of an extreme stance of removing the exemption in its entirety? Or do you think this was kind of already foreseen, but slowly but surely developed from 2013?
Very good question. I think two things. It happened so slowly that no one actually noticed. Secondly, bearing in mind we are at a deficit. So normally when you advise clients on where you look to set up tax residency, you look for a very stable jurisdiction. So South Africa is severely not hitting their budget collection, which is SARS's job. So either way, doesn't matter what tax it is, etc., they have to collect. So there's going to be either an increase in VAT, which we tried to see, they slightly reduced it. They're going to consider a wealth tax. They're going to consider whatever they can to make that up. So then going to retirement funds on face value is incredibly desperate. However, when we look at cross-border tax and international tax, the tax treaties between South Africa and various other countries actually has left quite a, if I may say, very valuable loophole for even some of the clients I've consulted with. I'll use the UK as an example. They tax based on tax residency. So similar to this exemption that is now being removed, SARS wants to tax on tax residency. So the UK DTA, for example, will say, we don't tax it if you're a tax resident elsewhere. South Africa, UK individuals coming to here trigger tax residency, then per DTA should pay tax here. But locally, domestic law says you don't have to. So those individuals actually aren't paying tax at all Great for them, bad for SA. In other words, especially when you are not making deficit, like I said. Bearing in mind that those entering South Africa are generally those who want to retire and very wealthy. I mean, you're talking about pounds and US dollars and highly appealing. So it's twofold. It's desperation, but also in the sense, if I may say, it's a problem that has been occurring since the DTA has been in place with certain countries. So, yeah.
I know, John-Paul, you've also been heavily involved in the discourse around the two-pot retirement system. And I almost explain to my clients that we are encouraged not to touch retirement funds. We have a very poor saving culture in South Africa. But when we look at it from a tax perspective, are we now dealing with individuals who have gone abroad? Relating to foreign employment, they have elected to contribute to a foreign retirement fund, and over a period of time, having saved up, are you telling me now there's going to be a tax event for certain individuals that SARS gets a piece of the pie?
Correct. Again, two things, if I may say. Not that I'm trying to always answer in two ways, but two things. It's based on tax residency. Obviously, there'll always be a treaty, well, in a jurisdiction that has one of us.
Yeah.
So it's not like it's a be-all and end-all. But two things. If you are a SA tax resident, generally you don't have a foreign pension fund unless it's a privately purchased one. Okay. Bearing in mind, the exemption that's being deleted only covers, so generally you get three pillars of pensions or retirement funds, if I could call it that. You get Social Security, Switzerland, the US, etc. Being a citizen means you get Social Security. Secondly, by employment, like South Africa, you have to contribute to a retirement fund by law. Thirdly, you get privately purchased retirement funds. The third option is not exempted under this exemption that's being removed. So it's only those first two that are being removed. So either way, the third one is still going to be taxed, was always taxed in South Africa, if you were a tax resident or not. In terms of those going abroad and coming back, very good question. If you are non-tax resident, then non-taxable foreign pension. If you come back and then start to withdraw or make withdrawals from your pension and you're a tax resident in South Africa, that would then mean that you're taxable in South Africa, then leading to a double tax event because your foreign pension is based elsewhere. So depending on what your DTA or double tax agreement states, so things like UK, Australia, etc., give exclusive taxing rights. Others, like the US, incredibly more complex. So those South Africans working abroad, if they come back, unfortunately to bad news, re-trigger tax residency and they get to retirement or want to use it in 5 years, 10 years' time. If there's, in South Africa, no DTA obviously applies because they're only in South Africa. Yes, South Africa will tax that foreign pension.
Okay. So we know that the law hasn't been scrapped yet. The draft taxation laws amendment bill is open for public comment. And that's very good because we live in a democracy that's very participatory.
Correct.
So we want to encourage taxpayers to give their comments, as well as tax practitioners in the field, to see how this proposed amendment will affect their clients. With that being said, what are the type of views you think we might see post 12 September 2025's deadline for public comment?
From a South African perspective, the general population, bearing in mind, very few individuals are those who can afford to pay tax. Very few individuals are those who have pension and retirement funds. So the general populace, this doesn't faze them. This is great news. We're taxing foreign income. So in SARS's mind, yes, those people who go abroad and work, but that's a minority. So in general, it's South Africa, it's a win for us, in other words. Comment-wise, I mean, there's already been a few of them expressed by some of the trade unions, for example, etc. Is essentially that, not that I agree with it, but that they're taxing the wrong kind of individuals. Firstly, it then also, like I said the other day on Newsroom Africa African Newsroom, is essentially that this does not incentivize individuals bringing money or going abroad as an SA tax resident and coming back. Because if I come back, everything I've earned in my foreign pension is now taxable. So those who have ceased their tax residency, number one, will encash their policies and take their pensions out because it could still be taxed here. Secondly, those who are planning to come back will also then encash their policies, move it somewhere else, and only then come back, for example, or whatever the case may be. So this really just is a massive problem, not just for us South Africans, but bearing in mind that I'm not going to quote stats, but we also had obviously a large amount of people leaving the country, which is cross-culture, cross-race, by the way. Secondly, we had the largest number of individuals entering who are millionaires as well, top 10. So those individuals now coming to South Africa who have massive pensions and retirement funds. I spoke to a client the other day, head of a massive corporate bank, done well for himself, found all around the world. He doesn't want to trigger tax residency here. So he'll spend 4 months here over the year. The rest he'll spend somewhere else. So instead of him retiring here, he's decided elsewhere. So that's the kind of implications. It's not just those South Africans or people. We're talking about big people who love to retire in South Africa. So I know the purpose was to collect more, but the problem is that less is going to come in to collect from.
Okay.
Yeah.
So would you say that this proposed law change is also key for those South Africans who financially immigrated and maybe didn't consider their circumstances changing and how that would impact them if they do reinstate their tax residency in South Africa?
Well, 100%. Firstly, those who, I know we've used this a few times, the term, a head in the sand approach.
Correct.
In podcasts. But those who have been doing that, this will be a wake-up call for them because their foreign pension, either way, is going to be taxed in South Africa if they have not formally ceased their tax residency. It doesn't matter how long you've lived abroad. I had a consult earlier today, actually, someone 2008 left. And I mentioned this to them, and all of a sudden, in their minds, they have to cease tax residency. Bearing in mind, after 3 years of being continuously a non-tax resident of South Africa, you can encash your entire pension fund or retirement funds, whatever the case may be, and move it offshore. So I see a massive increase in that happening. Everyone's going to move their stuff offshore. So firstly, they're non-tax resident, they'll formalize it. Secondly, their pension funds, they'll pay tax here, but based on tax treaties, either get a refund and just rather move it offshore because there's uncertainty. Because don't forget, removing an exemption, like I said, on retirement funds are sacred, So
do you generally find that clients are more interested in the tax treatment of retirement funds in their years very close to retirement? Or is it something that you see expats consider way in advance to get advice on how will my retirement funds be taxed?
Unfortunately, the former. Generally, I'm getting calls from clients who are working around the world. They say that they're going to give themselves 5 years, but JP, this is to set up my retirement. So I want to make it most efficient as possible. So it's generally those close to retirement. I would say about 5 years away, trying to plan. Like most South Africans, like you said, we've got a poor saving culture. I don't know the stats again, but very few people can actually afford to retire. So this throws a spanner in the works because those people who are spending those 5 years abroad want to come back to their family and retire here. That foreign pension is taxable there. Well, here now, if you trigger tax residency. So their plans, yeah.
Is there anything to read into this proposal being made shortly after the introduction of the two-pot retirement system?
I definitely think so. That's why I say it's happened so slowly that people have just missed it. Both know, and we both wrote the article together that was in Business Tech and Daily Investor, etc. And this has been on the cards since 2013. Retirement funds, amendments, and this kind of thing. So I think for a long time they've focused on it, but been a bit hesitant to really touch it or make plans. And it's the first time, well, if I can say, South Africa is very slow in terms of our legislative process. We all know that. And the fact that they are already announcing effective date of next year, March. It's incredibly short notice if you have not been following it. So picture everyone about to retire. They've set up their retirement, and now SARS, the Treasury and SARS announced this. Their retirement has completely been not destroyed, but thrown off track. How do you plan for that on such short notice? Definitely something to read in. And yes, there were 2 points for this two-pot system. Those who can't afford those foreign pension funds at least have immediate access. But you can't encash by resigning, for example, etc., dealing with our unemployment rate. Secondly, it's also to maintain your long-term savings for retirement. And I'm not sure if it was planned as such that you can't take it out unless you cease tax residency under the 3-year lock-in rule. But generally, that's only for South Africans. So I don't think it's really too strategic. But I would summarize it by saying, but they've been looking at the retirement funds for a while now. So, yeah.
I think it will also be interesting to kind of have statistics on how many South African nationals have seized their tax residency to meet the 3-year lock-in rule and take their retirement funds out of South Africa to place it elsewhere. Because I think there's a correlation between an uptick of those taxpayers' activity linked to this possible amendment that we are seeing.
Correct. I would say correct. I mean, the general consensus is, well, I say general, so it's not everyone, but those who have left South Africa generally don't want to come back. There's a sentiment that their funds here are at risk due to the exchange rate. So normally they want them out. Full stop. Obviously, they don't want to pay tax here, but SARS has the right to tax it generally. So there is an uptick in that. A lot of clients I get actually start at the end by saying, I want my pension fund. I said, you first have to start from the beginning, get your non-tax residency. So that is definitely the case. 100%. And we both know that they've formed this foreign employment unit. Don't forget, foreign employment, which means contribution to foreign pensions, etc., etc. So, I'm not saying SARS has been strategically planning this, but it is very interesting, if I may say that.
What would your advice be to taxpayers who are abroad, considering the short notice of this possible amendment coming into place from 1 March 26?
I think firstly, submit your comments. I mean, we both know our managing partner, Jerry Buerta, who has stood in Parliament defending the expat tax exemption. This being very similar. This is an incredibly important change to our law. And bearing in mind, yes, there's a double tax treaty that will also still be there. But in terms of domestic law and advice to clients who have planned 3 years or 5 years in advance to come to South Africa and based on their pension being offshore, will not be liable for certain taxes until they trigger tax residency. And even then, their pension's exempt. I've got clients who, how do you talk to those clients? How do you deal with that? It's someone who's set up their life in a way and a manner based on our law that is all of a sudden is going to be deleted, is the correct word to be used. So I would propose, please do comment. Secondly, please do consult a tax expert. And I'm not talking, unfortunately, a general tax practitioner or general tax individual. Cross-border tax is incredibly niche. So find out whether your country has a double tax treaty with South Africa, if you are related to South Africa, or if you're going to be triggering tax residency here. Secondly, go and look at the article. It ranges between 16 to 19 in your DTA. See what it says. Not a lot deal with exclusive taxing rights. Bearing in mind that the DTA still might say it's non-taxable in SA completely. Otherwise, it will say it's completely taxable in SA. Otherwise, it will say it's maybe taxed in both. Then you use tax credits. But so I would say, firstly, comment. Secondly, find out if your country is a DTA with SA. And thirdly, consult with a professional, if I may say, such as yourself, on these topics, so you can, again, urgently plan, which is never the best place to be in, South Africa's laws changed, or well, in draft format. So, and is set to change. So, the worst thing you can do is wait, if I can say that, if you're relying on your pension or retirement. Yeah.
I think that's very good advice. Just also underscoring that there are some individuals who have planned their mode of life and finances in such a way for them to live a certain quality of life off their retirement. So understanding how that retirement fund might be taxed is incredibly important, because a chunk of that being contributed to tax, if you thought it wouldn't, really does make a difference. Well, I don't know if you have any comments on that.
Yeah, so in South Africa, not a lot of people are aware, but we've got the two-pot system, which is 3 pots essentially. First pot, savings pot. You can withdraw, and per tax year, for no reason, it's taxed at your marginal tax rate, which is whatever you earn in your salary, and that tax rate it adds to that. So that's your income tax rate. Income, in other words. Secondly, if you were withdrawing on a monthly basis, let's say it gets a maturity, etc., it's income. If you make a lump sum withdrawal, there's a separate tax scale that it works on, which goes from 18% all the way up to, not 45%, but let's say 36%, for example, 38%. So if you've got a large amount that you are withdrawing, your tax is substantial. So if you think, if you're looking at your retirement fund and you're saying, look, guys, I've got 5 million. Let's say you bank on a 38% tax at SARS. Then all of a sudden you think, oh my word, it's not as big as you thought. And like I said, very few people, I don't want to give stats, but very few, and I'm talking, less than 10% can generally afford to retire in South Africa, which is scary. And that's what people aren't aware of, the tax when you withdraw. So, it's incredibly scary, and that's why the last thing I can say, there's not much to say. SARS and the legislature do what they need to do. All you as a taxpayer need to do is firstly be abreast of it, and secondly, be proactive, because it's not going to wait for you. The last thing you want is to find yourself in a position where you actually have no clue what to do anymore, because your retirement is not enough. And that is the case generally already with most South Africans. So I'll leave it there.
John-Paul, thank you as always for your valuable insights. And thank you to our viewers to joining the podcast of Tax Consulting South Africa. Till next time.
Thank you, Delano. Thank you.